I believe that India now has over 300 family offices.
See, I call this as expertise fragmentation.
So, what's the single biggest blind spot you have observed in how they assess risk today?
If a family office is not investing within a time frame, they would go to a structured finance, they would go to another option, and that option is gone.
Managing wealth is complex, but making decisions shouldn't be. Hello, everyone. Welcome to the episode 7, which talks about beyond public market, the alternative asset, and the unlisted investments. So, without any further ado, let's get started with our very first question, which talks about. So, Mr. Sanath, with wealth shifting to the next generation and rising interest in alternatives, how do you see unlisted investments and key sector evolving?
Right. So, uh, you're right. I think there has been a significant shift into the way the family offices, especially the next generation of the family offices, views the alternative investments, and alternative investment classes, and especially the unlisted sector. The next generation, the take of the next generation is very different. They are ready to take a one notch above risk. So if the risk can be taken one notch above, they evaluate investments directly into the unlisted segment. So to break it down further, earlier if a family office wanted to do an investment, they would co-invest either with the larger funds, or would go ahead and invest into an alternative investment fund, or be a part of as an LP into a larger fund. But now the second generation who has been managing the wealth is a second or the third generation or the next generation who is managing the wealth, and the family office is taking a different stance. Now in that, when they are looking at unlisted segment, uh, there are two things. The returns are naturally going to be much higher, and they will be having a much bigger IRRs, but the risk in reference to the diligence is also higher. From our take point of view, I'll divide it into two baskets. One is from an industry standpoint. We have particular take in certain sectors where we are quite good at. Like probably I had mentioned in the earlier episode as well. We are quite good at infrastructure. We understand the infrastructure segment. We understand healthcare quite well and technology quite well. Uh, Basis our knowledge on all these three sectors, we believe data centers would be one of the very key sector of investment as it will be growing. India has already been catapulting and moving very fast in the digital infra. AI digital infra is further adding it up. So it essentially sees that the digital infrastructure would make the necessity of data centers quite large, and thereby the investments into the data center would grow. Now, that being said, a data center is a infra play per se. It will have the demand, it will generate the return, but it will also have longer gestations to generate a return. So the way a risk needs to be identified, the way the risk needs to be judged, will be very different. This is one sector where we have a take. The another sector that where we have a take is particularly into pharmaceutical, especially into API and formulations. We believe the pharmaceutical segment now will also further grow very fast. Healthcare, especially in India, India has been post COVID, been able to actually restructure the supply chains quite well in the healthcare. Now, considering that, the core API development or a core API manufacturing and formulations, especially these two, has been growing very fast. We have even seen acquisitions happening and consolidations happening in India. Considering that as a sector with its recurring nature of income generation capability, we believe that is also a second sector where the focus can be. The next where we see is essentially because in investments into infrastructure is going, the value for the supply chain and warehousing will also grow. So the logistics and warehousing is the third sector where we see that it might have quite upsurge, and thereby it's another industry where we see it can generate much higher IRRs for an investment that might come over the time, right? So these are primarily the three sectors that we see. But when we are seeing these three sectors, and the next generation is trying to assess the investing directly into an unlisted company in these sectors, unlisted essentially in India, which is in the mid segment, one which is around 250 300 crore of revenue, which is with the higher EBITDA and high PAT, to a 700,000 crores of revenue with the high EBITDA, high PAT is a very, very, very dense section requiring a lot of capital. They are looking forward to catapult very quickly, very large, but has a dearth of capital. The capital can either come from AIFs which are offering structured finances, or can come from the family offices. Now, if the family office is ready to take that risk, which they are, there needs to be a very strong diligence and governance mechanism to control it, and control, manage, and oversee it. And there is where guys like us come in, wherein we want to be that advisors and partners to family offices who can manage the governance, manage the diligence, and be that point of trust. So goes our name as Trust One. So and thereby be able to carry on that knowledge and build that asset class book. So even if there is a 20% exposure that a family office is taking at the alternatives, essentially in the unlisted segment, we want to be that preferred partner for them in managing that book for them. So that's mainly our vision also, and our take in reference to how alternatives and unlisted segment is growing, right? So yeah.
That's very insightful. And so, building on that, I believe that India now has over 300 family offices. So, what's the single biggest blind spot you have observed in how they assess risk today?
Right. See, I call this as expertise fragmentation, or too many advisors making one soup. What by that I try to say is the family offices, the 300 family offices you mentioned, have grown in the last 5 to 6 years phenomenally. It's been at least 4x. Most of these family offices have set up their structures as either an AIF or more or less a single fund, a single office, single family office fund, and are partnering with different advisors, may it be at the legal side, commercial side, financial side, etc. Now, when these advisors plus the family office with their own thought process sit down together to take a decision, like an investment committee would do, there is advisors who have independent decisions or independent biases at their silos, right? Now, each of these advisors with their siloed advices plus the investor or the family office with his own thought process can lead to multiple different clashes between multiple different advices. That means to say, if a legal advice is not overlapping with the tax and is not overlapping with the financial, it might take enough of time for an investor to invest in a company. And we need to understand, as we spoke earlier, in the unlisted segment is a segment which is looking for capital continuously. Now, if a family office is not investing within a time frame, they would go to a structured finance, they would go to another option, and that option is gone. In either given case, they can always go to, if the company is really doing good, then they might even go to an IPO, and you will not be able to get a company at a value or tap a company at a value that can generate a higher IRR for you. So the time, in my opinion, for creating an alpha IRR is very, very necessary. So if someone wants to create that alpha IRR, then they need to have a very structured approach in which all the advisors, their intelligence, and the investors' legacy of a legacy of how they think an investment should be done should be brought together. There is where again we believe that when we come in as an advisor to someone, we should bring all these expertise with us in a single room along with the product kind of an platform to merge all of them. So like I said, the blind spot very much is that there is too many advisors in the room, and that's creating overlaps between the different advices, right? So yeah.
That's a very important observation, and especially many family offices probably underestimate that. So, with that, let's move to our next question. So, behavioral biases is the key theme at our summit. So, how does your AI platform help neutralize emotional decision making in high stake deals?
So my response to that is, our platform basically removes a bias by a simple 3-step process. One, by having a pattern interruption. Now, through a data points, right? So if there is an investment I want to do in a distressed asset class, which is going to turn around, I won't take a biased decision basis my understanding of the turnaround, but I will take a decision basis a comparative analysis of all the data points that is available in our database for that industry, for that transaction in that time period, and thereby prove it by way of a pattern. Now, the second is put down all the covenants like a devil's advocate. So, if there is a fall that is going to happen, what needs to come out as a covenants? And the third is essentially scenario analysis. When we say scenario analysis, we also call in financial modeling this as a sensitivity analysis. What our model has been building or doing is considering the financial and the non-financial factors. We run through as many number of scenarios that can be possible in a particular investment, and bring it out to the family office to say that these are the different scenarios of risk and these are the different scenarios of rewards, and basis that you can take up decision making. Now, all this while, the most important thing that we do is to focus on accuracy in how we are doing the risk analysis through our AI model, rather than just throwing up data. So this is basically the 3 steps in which how we remove the biases for any investor.
That's a great perspective, especially using data and intelligence to balance emotion is becoming essential today. So before we wrap up, let's do a quick rapid fire round. So Mr. Sanat, one investment trend family offices should watch closely in 2026.
I think data centers, basically because of the digital infrastructure and the AI.
Okay, so one risk according to you that most investors are underestimating.
It's post-investment governance. The post-investment governance is quite underestimated today.
And according to you, if you had to summarize Trust One's value proposition to a family office principal in one sentence, what would it be?
Any family office where you are facing a decision, may it be $1 million acquisition, cross-border transaction, restructuring, tax structurings, etc. We make your decisions faster, more accurate, less risky, because we have now 30 years plus intelligence put up in a box with our AI. And that's where we call intelligence, that's where we call insight meets intelligence.
That's a great one, sir. And with that, we wrap our episode 7, which speaks about Beyond Public Market, the alternative assets and the unlisted investment. Thank you, Mr. Sanat, for joining us, and thank you for this insightful conversation.
Thank you so much.